Markets moved today as investors reassessed a key assumption about the double threat of energy inflation and financial stability. Under the surface, today's reaction revealed a market trying to price a new and subtle shift in the Federal Reserve's priority function. U.S. equities clawed back most of yesterday's losses, staging a moderate, broad-based rally. All three major indices finished in the green, led by the Nasdaq, which gained nearly 0.7%. This relief was fueled by a significant retreat in bond yields. The U.S. 10-year yield dropped nearly 1.5%, cooling off from last week's violent spike to settle back near 4.25%. However, the inflation tax from energy only intensified. Crude oil re-spiked by over 2.7%, breaking well past 102, as the 72-hour diplomatic window in the Strait of Hormuz effectively closed without a deal. Gold also rose over 1.4%, confirming its return as the favored hedge for a stagflationary regime. We saw a sharp pivot in sector leadership. Materials and healthcare, two sectors that offer either physical asset protection or insulated acyclical earnings, were the surprise leaders. Energy stocks, surprisingly, were the only decliners, suggesting institutions took profits on energy majors to fund a rotation back into defensive growth. The market psychology is being pulled in two opposite directions. The bad news is that the shipping truce in the Strait of Hormuz is officially over. The humanitarian corridor has closed, diplomatic efforts to secure permanent transit failed, and commercial transit has been immediately suspended. This resets the geopolitical narrative back to prolonged supply crisis, and is why oil spiked again today. Confirming this, United Airlines noted that high fuel surcharges are now forcing consumers to downtrade from international leisure to domestic options, compressing margins and confirming that demand destruction is real. However, the good news, and what powered the rally, came from a subtle shift in Fed communication. Regional Fed presidents signaled a policy stability put. They stated that while inflation remains the priority, the committee is now closely monitoring financial stability risks following last week's yield spike and private credit redemption halts. This tells institutions that the Fed may pause hikes if high yields start breaking the regional bank or private credit clumming, reviving hopes of a recessionary pause. This rotation into insularity was perfectly expressed by corporate bellwethers. Eli Lilly shares rose as analysts highlighted that demand for its GLP-1 and Alzheimer's drugs is completely insulated from high oil prices or Fed rate hikes. Institutional money spent the day on an emergency repositioning into quality. We saw flows return to technology, but it was highly selective. Capital is concentrating only in the hyperscalers and AI infrastructure winners, companies with fortress balance sheets that can withstand 4% plus yields. Pure software plays are being abandoned. Defensive cash flow stability sectors like healthcare saw significant inflows. The core trade of the day was unwinding tactical hedges, including energy stocks, to fund this return to defensive growth. Materials also saw strong technical buying as a copper supply crunch intersected with inflation hedging. In contrast, sectors with high duration sensitivity like real estate and those exposed to demand destruction like consumer discretionary were abandoned. This reveals that investor psychology has shifted from truce relief to securing cash flow stability before the next escalation. The most critical risk the market is overlooking today is the secondary energy supply cliff. What the market may be overlooking: everyone is repricing a shipping freeze, but the real risk is that the physical production facilities in the UAE and Saudi Arabia are still running out of storage. Where fragility exists, regional port storage is reported at maximum capacity. If the strait remains difficult for commercial transit for another 72 hours, regional wells will be forced into shut-ins, or physical shutdowns. Unlike a shipping freeze, a well shutdown can take weeks to reverse, even after a diplomatic breakthrough. The market is completely ignoring the geological reality of physical shutdowns. Today reflects a short-term narrative adjustment within a medium-term stagflationary regime. A change in expectations. The market is testing the idea of a recessionary pause. Investors are betting that the combination of private credit stress and consumer demand destruction, the bad news, is now bad enough to force the Fed to pause its hawkish path, overriding the inflation risk from $100 oil. This signals a potential shift in how markets interpret Fed policy. The central bank's inflation commitment is strong, but its commitment to financial stability may be stronger. The entire macro narrative is holding its breath for the next 48 hours. The primary narrative shifter will be the regional port production reports. Any news of mandatory well shut-ins in Saudi or the UAE due to lack of storage forces a catastrophic global trade repricing towards 120 plus oil. The primary confidence breaker will be the Q1 bank capital stress reports on March 27th. Any surprise weakness in regional bank capital reserves will violently revive the 2023 banking crisis narrative. One open question investors are debating right now is whether this regional Fed focus on financial stability is a sign they are about to blink on the inflation fight, or simply a tactical pause before a final hike. I'd be curious how you see this. Is the Fed put back, or are we underestimating their resolve? Let me know your perspective in the comments. The broader takeaway from today's market reaction is that the rally was tactical damage control, not a regime change. The Fed's stability put provided relief, but the Hormuz truce expiration guarantees that $100 oil will continue to compress consumer margins, maintain elevated cash levels, hold physical assets as stagflation hedges, and prioritize insularity, defensive growth with insulated earnings over broad market exposure. The Fed's stability put has arrived, but the physical reality of a $100 oil regime remains the dominant constraint on earnings. I'd be interested to hear how you interpret today's signals, especially the rotation out of energy. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.